I didn't come back to the second stage search fund idea, but one of the things that we've done quite a bit of in the recent years is we've had very targeted search funds. So entrepreneurs who have come out of some of our core industries, we do a lot of investing in small market cable television, other small market media. We've looked at a lot of broadcast TV and small market radio and some other niche media businesses. So one of the strategies that we've had is to find some of the best operators in those markets, people who want to stay in, but they don't want to keep running, 20,000 subscriber systems for, one of the large MSOs. They'd rather get out, buy something. They've always wanted to, be an owner-operator. So my comment certainly relates more to second-stage search fund entrepreneurs, but I think also, if there are people who have some extensive experience in an industry and they still want to be in that industry, and it's one that, there is some fragmentation of the industry and there is an opportunity to buy and operate. I would, if that's on your radar and you're passionate about it, that's great. From our point of view, that's a terrific thing.
I think you can also be passionate about the process of building a great company. Some people know the industry they want to be in and they're passionate about that industry. But I also think you can say, I'm passionate about building a great company and I'm going to find the right industry. I don't know what it is right now. These are some of the ones that I've analyzed and appeal to me for the following reasons. But I'm not coming to you as an investor and representing that I'm going to end up in one of these industries, but I am going to try to build a great company, and I'd love to have you be an investor. I think that's a credible thing to say as well.
I'm living in that scary time right now, I guess. You learn just along the way, I found, and you lean heavily on the board and the other investors who have the time and inclination to be active with you. And I think at the end of the day, it's not rocket science. I mean, structuring fancy warrants and earnouts is a little more complex, but once you get down to the basics of, cash at close, seller note, and earnout, those are the kind of the key knobs that you use, and then it's negotiating with the seller. I had zero private equity experience or deal experience, and I don't think Josh or I feel handicapped by that at this stage.
I would add to that, hire a very good lawyer. Just try to get someone who's an experienced deal maker lawyer that can guide you through that process. And it's going to cost you money, but certainly it's an invaluable resource.
Yeah, I think in terms of putting together, figuring out what are you going to pay and how are you going to put together an offer and what is a letter of intent. I think I had a couple of friends who had bought companies, and so I got their letters that they sent to the sellers, and I got their letters of intent, term sheets, and just collected a bunch of them and tried to make up my own from there. And I think, having a good lawyer, I guess that's after a deal has been accepted, and I had a lawyer take a look at my letter of intent, but I think I went off of other people's templates.
We use them, but we don't use them exclusively. I think once you get to know a group of business brokers, they also get to know what you're looking for, what industries you're interested in, what size range you're interested in. And at the end of the day, a business broker can save you a lot of time because they'll at least bring you a business that's actually for sale, as opposed to one that's just trying to get a free valuation service from you.
I didn't find brokers to be helpful when I was doing my search fund, and I just preferred the approach of targeting an industry and getting to know that industry. And I think even once in the industry, there are some brokers in our industry. I felt I didn't really need them because it's such a small industry that I could source deals on my own. And some brokers that that broker's fee is a chunk of business that can make the difference between whether they're able to close a deal or not. So.
I had coffee the other day with a man named Chris Flanagan. He actually was the author of the search fund study that some of you have seen. He's been looking for a company based in Dallas. He's based in Dallas looking for a company. He's been out looking just about a year. And I said, Chris, what is the single thing you would do differently in the past year if you had it to do over? And he said, I would not search opportunistically. I would search only by industry. He said, I've wasted a tremendous amount of time trying to analyze the companies that friends or bankers or brokers brought in, and it took me a long time to realize that I can't just analyze the company. I've got to analyze the industry and the competitive position, and it's a very inefficient way to search that way. So that's a little bit counterintuitive in the sense that you think, well, I want to buy a company. Why don't I tell my friends I want to buy sort of this kind of company with these parameters and some of the things that have been mentioned, but not be specific about the industry? And I think the answer is that it's very hard to and inefficient to analyze the flow of companies that comes in and time goes by. Your scarcest resource is your time.
I actually think the data is different than that. It's interesting because I think you would think that second stage search funders have a better track record than first stagers, but at least our look at the data suggests that first time search funds are still a very good investment for somebody to make. And I think part of that might be one of the hypotheses that we have is actually on the second stage group, that there's a sense that I'm more experienced and I can handle more complexity, more a bigger company, and they have tended to get themselves into trouble sometimes on that second go-round. So at least our look at the data is that first-time search funds overall have been very successful. I think actually the GSB study would support that as well. But the key, if you look at what's been successful and what hasn't, is the quality of the business. And it's things like one of the things we think is one of the insights into selecting the business is the complexity of a company, of the industry. For example, if the CEO and his direct reports are spending all of their time thinking, okay, here it is, November 18th, how am I going to make the November numbers? What do we got to do? How are we going to scramble around and get that done? Versus if they have a business that is, has characteristics such that the operation of the company is less complex. It's got some other characteristics, very strong recurring revenue, high margins, etc. It allows the team to step back and be more strategic and be thinking about how to add value in a much more strategic way.
I think that what you do in terms of search fund is you raise enough money to last for a 2 to 3 year period and try to do a budget of what you think your operating expenses are going to be. So the size of the initial search fund really shouldn't matter as to what deal size you end up doing. You certainly want to give some indication to your investors as to how big a deal you want to do, because you want to let them know that you might be calling upon them for an X amount per investment. But I would tell you not to limit yourself to the amount of capital to be raised shouldn't be the limit to what you do. And if you find a deal that's bigger than what you originally thought you would do, and it requires more capital, well, take it to your investors and see if you can get it done.
In terms of the amount of money, it can range anywhere from $15,000 to $35,000 an investor typically. It's maybe a dozen or so investors would be the right amount. More than that for a first-time search fund, you may be herding cats. Even with a dozen, you may be herding cats when it comes time to close a deal.
How many people did you have to see to get 12 investors?
We made in-person or over-the-phone pitches to probably around 75 people. And I think that's probably middle of the road. You basically want to only accept a search fund investment from someone that you're quite confident can follow on with, 10 to 15x their initial investment if you bring them a deal. So whatever that means, so personal net worth of, $5 to $10 million. It's hard to say because you can't just walk in and ask someone what their personal net worth is. So there's really no easy way to determine whether you kind of just get a general sense of how long the person's been in their career. If they've got family money. It's you wind up sometimes accidentally pitching people who don't have money, and they kind of tell you. People pitch, their family dentists and stuff like it. It's you can get right down there. It's occasionally I know other search funds that have taken investment money from friends, just like associates who clearly won't be able to follow on with a full complement of follow-on capital, but they feel it's nice. It's a nice incentive for them to really perform because they don't want to let their friends down. It's also a nice signal to other investors that you have one or two friends or family in that, you're going to do more than lose investors' money. You lose personal money in a way.
If I may add, I think we took a similar approach to the way that we assembled the board. We thought very strategically who we wanted and why. And I think our most effective closings on potential investors were those that we could go and say, Barry, we want you to be an investor, and here's why. Because you bring X, Y, and Z to the table, and that's exactly what we're looking for. So try to, and if possible, make a list of people that you would want, and try to tailor it to very specific reasons why you want them in your group.
One way that raising a search fund often goes, although there are variants, is that you see 60 to 80 people. You call a lot more than that because some just blow you off on the phone, but you have meetings with 60 or 80 people, and you get a few early adopters who say yes. You get a lot of people who say no, and then you get some people who say, well, this is all new to me. I don't know. Keep me posted. Maybe later, not now. And when you raise, let's say you're trying to raise 12 units, when you've raised 7 units, you then can go back to that last group of people and say, the train is leaving the station. Would you like to be aboard? And psychologically, that's a very different proposition from saying, we're thinking about this train. Would you have any interest in a train ride?
And by the way, we don't know where it's going. I think the biggest blow that you can have is start working on a deal, and you actually get into an acquisition process. You sign a letter of intent. You're all happy. You think you're going to get it through. You start spending money in accountants doing accounting due diligence. You start spending money in legal due diligence, and all of a sudden the deal blows in your face, and you're out $40,000, $50,000 in fees. What do you do? I mean, that I think is the one thing that you have to be really careful as to when you start spending actual money in each deal, and try to mitigate all the risks associated with closing that deal before you actually open the faucet and, okay, start drafting documents, start doing due diligence on the accounting side. That can, I've known some people where that has happened, and it actually happened to us at one point in time. And fortunately, we had negotiated a breakup fee, and luckily we were able to collect it. But I think that's in our view, that was the biggest potential unexpected that you can have.
Let me comment to this, because I think after raising a few $100,000 by basically selling someone an option to invest in you, you get pretty bold. And so I went to lawyers and accountants, and I said, and I interviewed a bunch of them. And basically the deal was, I'm trying to put together an acquisition, and I'd like you to work for me pro bono, and I'll pay you when the deal gets done. And if the first deal doesn't happen, I'm not going to be able to pay you, but we're going to get a deal done. And surprisingly enough, there were some lawyers who were willing to do it. I mean, I think I met with two lawyers who were willing to do it, and then I think Coopers and Lybrand, an accounting firm, also was willing to do it. So
they've been willing to do a lot of things lately.
Yeah, are they still?
Arthur Anderson too, or
no? So you can be pretty resourceful in ways to conserve cash, and I remember I paid rent for, I think it was $318 a month. I still remember that. That was a big check.
Personal money, how about 3 years of foregone income? I think in most cases, you don't actually put your own money, but what you do is that during the search fund period, you take a very reduced salary, what you would be making in the open market. So, if you figure you'd be making, I don't know, $75,000, $100,000 at a business school, you're paying yourself $50,000 during the whole process. In effect, you're contributing the difference of that money throughout the search process. I
don't think you need to put your own money in. I did, but I don't think it really. I thought it was going to make a difference when I was selling my search. I don't think investors really care. So.
We didn't put any personal money in the search fund, but if we have a couple cents to rub together, we may put it in the deal, and that may be.
I'm from the era of $50,000 a year compensation. I don't know what it is these days during the search.
40.
40? Yeah.
25.
Is that what it is today? Post-deal post-deal compensation, we were at, I think, about 100,000. So this is 1997, and kind of, I would say, below market until maybe two years ago. And then there's the equity component, which obviously you're sweating for. So, but I think it probably depends on the size company you buy and whether you have a partner or not. There are lots of factors that impact your current compensation.
The deal fee and carry and stuff like that.
Yeah, implicit in John's comment is a carried interest that the search funder or search funders get. Some of it is at the closing, some of it may vest over time, and some of it may be performance based, so that they're really not expected to put money in, as has been said, and they expect to end up with 15 to 30% of the deal. It varies according to the situation, but the real on the come is the equity. That's really why you're doing this financially. That there are other reasons to do it, but the main reason to do it financially is for the equity interest. And my impression, and John Fowler, maybe you can correct me if I'm wrong, is that search funders lately have been taking $70,000, $80,000 salary kind of during the search fund. Is that?
Yeah, around 70. Although, I've heard of more, I've heard of less. But what I've also heard is that no investors have ever pushed back to say, take less salary. If you ask for it and you can justify it, you'll get what you ask for.
That's it's a challenge because you have, you're going to close on a multi-million-dollar transaction. You don't have the money, and you're telling them you do. Or at least you're saying, here are my group of investors. They're, I brought them up to speed on the business. They've seen, you can walk them through it, and even having your investors maybe speak with the seller. If the seller is nervous about it, you can always have them talk to some of the folks at Housatonic Partners or one of your other lead investors. I think that helps. But again, getting to know the seller, and if they see you as credible and trustworthy, and you stick by your commitments and you're following through with every conversation you have, they're not going to have such doubts. A couple of things. One, relationship building, so they're not going to do that. I mean, really getting them to buy into you. And two is, in a letter of intent, you can actually put something that's legally binding in there, which we do. The letter of intent is not legally binding, except for one section, I think, where we say that it's a exclusivity clause where they're not going to shop it to anybody else within a decent time frame. So that helps. And also, when people sign a letter of intent, hopefully they're not going to go start looking elsewhere. And part of it is just good faith.
There's a big psychic element, too, in many of these transactions where you may often be dealing with a seller who is older, and you strike a bond with them, and they are thinking all the time, can I entrust my baby to this person or these people? There are non-financial motivations, too, at play, and to the extent that you can build those bonds, which John has alluded to, but I'm just underlining, it just strengthens your ability to carry forward the transaction.
I think it was you, John, that shared a bias that I share as well, that you don't, I think you're better off structuring something where there's a period of time where that seller is there to help you get over the hump, help you attach the customer relationships to you or somebody on your team. You want to move that over from them. I think it can be helpful with the employee group that they see a little smoother transition. But you want to have a relatively short period of time at which point it's clear that they are out and you are the only one then home. And I think sort of 6 to 12, maybe 15 months is kind of the right time frame. At least that's our point of view.
I think there are a number of new search funds cropping up, but shockingly, somehow we have not been competing against them on deals. I can't explain it. I think it's just a lot of deals out there, even though it doesn't seem like they get done every other day. It's a pretty big pool we swim in.
Yeah, I think it has something to do with the size range that search fund entrepreneurs are looking at, which is it's the reason Housatonic is so active with search funds is there's overlap there. And we just, 95, we count this up every year, but 95% of the investments we've made in our history were non-competitive, which is really, a unique statement in the private equity world. But I think, it has more to do with the size that we're all looking in, and there's just a lot of opportunity there. And
we also keep in touch with a number of the other active search funds, at least in the Bay Area, and we know generally often what industries they're looking at, so we don't overlap on industry networking, so we're not bumping into each other at trade shows.
The most common is always going to be a strategic sale to a larger competitor in that marketplace. That holds for Housatonic in our in our non-search fund deals. And again, I think it's a function of you're taking a company from sort of 20 million of enterprise value to maybe 50, maybe beyond, but you're in that sort of a realm, so you're not talking about sort of IPO exits, although there are some search fund deals that I think really are candidates out there in the marketplace now, but strategic sale is going to be the most common, I think.
I can talk about the geographic search since that's exactly what we did. There's some pros and cons. The pros is if you're from that geographic region, that might give you a head start in that you know the people, you know many of the sellers, you know many of the companies. You may have relationships in that area that hopefully will make it easier, or at least so we thought. And that's some of the positives that we see. Some of the negatives are that when you start doing your industry analysis and you say, okay, I'm going to pick these 5 industries that I really like. Oh, and I'm going to start with the widget industry. And then you say, okay, the widget industry is great, and there are only 5 companies in the area. And you go and talk to all 5 of them, and none of them want to sell. So then, you got to strike that one out. So that's how I would balance it. There's a good in that you may have a head start and that people, and the downside is that it truly limits the amount of potential candidates that you can look at.
I think on the first half of your question, certainly anything or companies with assets out there have been easier to get debt financing for most recently. We've certainly found that. I think John's point earlier about seller financing being a key part of your structure that you want for other reasons are becoming even more important now. That really what's happening out there to bring prices down is we're just saying, look, we just can't get debt financing, so we need a lower price. Plus, you're going to have to take some of that debt financing, so the seller notes are actually growing and are becoming more important.
It's a fairly hard job. Rafael and his partner did it, but it's a fairly hard job to convince investors that you can find a company in, let's say, the Bay Area. I think you really have to have a broader focus than that and say, I'm willing to go to these 5 western states. I'm willing to move anywhere, at least for a while. You know, it's not for the rest of your life necessarily. It might be for the next 3, 4, 5, 6 years, and maybe you can morph the company that you buy in Tulsa to move the headquarters here. Assurian, which is one of the great search fund success stories, bought a company in Houston and moved it to the Bay Area. But I think it's very hard to say we're going to buy a company in the Bay Area or we're going to buy a company in Chicago or Boston, and that's the only area we're going to look in. Investors really want more chances to win than that.
I looked at a lot of different businesses in my industry, so I got a pretty good sense of a quality company from not a quality company. And when you review financial statements in combination with a tour of the facility and really understanding their organizational structure, you get a pretty clear picture on what a good company is and what a not so good company is. And so we tried to focus. For us, it was, do they have quality client base, the repeat recurring type client base? Do they have a team of managers and salespeople who've been with the company for a while and who perform and do a good job? The quality of their assets. For us, it was the quality of the rental assets. Are the white wood chairs white? Those sort of things. You get a general. You walk into a place, you get a general vibe of what it's like. Is the owner someone who delegates or not? Is everything flowing up to the top and where they're making every single decision? I don't think you want to buy a company like that. But if you see that, if you walk into a business, you spend an hour or two there, you get a real good feel for whether it's a good business or not. And in combination with the financials, I think it helps you evaluate a business, and seeing a whole bunch of other businesses in that industry is very helpful. And it's surprising how people will open up their doors to you.
One thing that you learn, and it's the kind of thing that they tell you before you go into it, but you really don't learn until you're actually out there. One of the toughest things is to ascertain whether you have a motivated seller or not, or if it's just someone that just sitting there and one day you call and he says, well, maybe I don't know if I should sell my business or not. It sounds like a good idea, and then they just string you along in the end and say, well, I just wanted to know what my business was worth. So I think it has to start. You have to spend a lot of time trying to ascertain what it is, why this person wants to sell. Are they for real or not? I don't know. I can answer with a percentage, but every time that we got stringed along, we went back and said, what happened here? So, well, this person did not really have a need to sell, And I think that's very, very important. And those reasons for selling can be succession, health, divorce, a number of reasons.
We've only found 2 or 3 sellers that didn't think they wanted to sell, who then claimed they wanted to sell, but it's been our ongoing experience that they actually just wanted to sell for 7 times EBITDA or 6 times EBITDA, so they're not really realistically looking to sell. What we also look for with every seller is the true motivation behind selling. Like is it retirement, or is it they're getting out when the getting's good and something's about to fall off a cliff? You always got to raise an eyebrow when it's the 37-year-old selling the business, to spend more time with the kids at home, because if he's earning $1.5 million down to his pocket every year, there's something going on. So.
I think if you are married, I think the first thing that you need to do is make sure that your wife's on board. And I truly mean this, because once you embark on doing this, it is an emotional roller coaster. You don't know exactly where you're going to be living if you choose not to, like we did, do a geographic search. You don't know what company you're going to be running. It's a very trying time that can be very stressful on your spouse. So I think you need to make sure that she understands that this is going to be a roller coaster ride. Sometimes, you feel you're the king of the world. The seller just told you he definitely wants you to buy wants to sell the company to you, and then 3 weeks later you feel like the biggest schmuck because the guy all of a sudden doesn't want to talk to you anymore. And then you add to that this takes, some people get lucky or they work harder at it and get it done in a year, but others take 2-3 years. So that in terms of balancing your work life and personal life, the first thing that I would say is make sure that your significant other is on board. The one thing that is true, which is what I said before, you do have more control, or at least perceived control of your time as to how you allocate it and when things you can do on a personal level. But you're still going to